Kindly note that the views and opinions shared in this video are those of the speaker and do not constitute advice given by Classic Private Wealth. Any advice given by Classic Private Wealth will be in writing in the form of a wealth management proposal. Classic Private Wealth is an authorized financial services provider.
I thought that what I would do is just share a little bit of what keeps me up at night. So I'm not a real worrywart. I pretty much believe in making sure that your affairs in order and then come what may. But actually in the current environment, there's quite a bit to worry you if you follow the traditional dictates of financial planning. Some of them may not work so well over the next 5 to 10 years. And I'll get to exactly why that is. So I just thought I'd share with you what worries me. And what really worries me is the fact that returns going forward from this point may not be in line with historical averages over the next 5 to 10 years, just because we are actually starting at such a high point in the evaluation of many assets that it's difficult to see how we can get a fantastic return if we just invest and stay invested. And investing and staying invested is pretty much the strategy that is followed throughout the market. So I thought what I'd do is just kick off and give you a bit of a glimpse at what has happened to investment returns in the South African environment over the last 5 to 10 years. Johan, if you can turn your camera off, that helps the reception for everyone, if you don't mind, and also the sound. So if you want to say something, turn your sound on. Otherwise, just mute yourself if you don't mind. No, I see that you are muted.
Yeah, or put your hand up. There's a raise your hand as well.
There's a raise your hand thing. So the interesting thing in South Africa is that the traditional approach of pension funds, and also inside the advice that people get about retirement annuities, etc., is to go into a balanced portfolio. Now, we've got nothing against balanced portfolios. As Lee said, diversification is an important part of what you do. It says in the Bible, put your money in 7 or even 8 places, because you never know what disasters may befall the country. So diversification is not a bad thing in principle. But one of the problems that we have in South Africa is that our own markets are actually fairly concentrated, and there are very few safe assets in the South African environment. So it's very difficult to get true diversification if you are limited to the South African markets. But I thought what we do is just have a look at what's happened in South Africa over the last 5 to 10 years and have a look at what the returns have been. So what you'll see is a graph of the South African stock market, essentially from roughly over the last 10 years. And what you can see is it splits into 2 periods. There's quite a strong upward movement between 2010 and 2014. And then from 2014 onwards, it essentially stays flat with a little bit of variability. So it's not as if the market collapsed and in any way. All that happened is that the stock market after 2014 effectively stopped growing. So what you will see is that the market stays between about 50 and 60,000 for a 6-year period. And what that means is that the stock market didn't offer you the normal risk premium. So if you think about investing, then you actually have 2 sources of return. The one is the return on safe assets, which is pretty much what you would get on money markets, interest rates. That's the first part of investment returns. And the second part of investment returns is a risk premium of some sort. And that risk premium, the exact nature of it, varies between different kinds of assets. But the risk premium in shares, if you look at it in various countries, you would normally expect the risk premium to sit at about 6% per year, meaning you should beat inflation by 6% per year. So it's very easy to see that if you were trying to invest from 2014 onward into the South African stock market, there was nowhere near a 6% risk premium. In fact, you may not have had any risk premium at all. So if we were to just move on and have a look at how various funds in the South African market, and we've just had a look at a couple of the big providers, how various funds, managed funds in the South African environment perform in this environment. And what you will see is that I've got an Excel spreadsheet here with a number of funds in alphabetical order on the left-hand side, and then some returns, 1 year, 5 years, 3 years, 10 years on it. And I want to actually focus on the 5-year returns because that's really the period that already encapsulates that flat part of the market. So what you will see is that many advisors would typically say to you, as long as you're investing for more than 5 years into the stock market, you'll get a good return. And what we're seeing here is that you were in the market for more than 5 years and the good returns have stayed out. Now, one of the things that happens to these funds is because of the way they're investing and the historical return of various asset classes, they would actually couple a CPI number to the fund. They would say this is a CPI plus 6% fund. And what they actually mean is that if you invest into these kinds of assets, historically those assets have offered you CPI plus 6. That's a 6% risk premium that we were talking about. And now we see that the risk premium, so some funds would be 4, some would be 5, some would be 6, those who are more aggressive. And so let's just have a look at what happened over the last 5 years. And what you see, if we just start from the top again, is that if you were investing into the ABSA funds over a 5-year period, and this 5-year period, by the way, inflation was closest damn it to 5%. So if you were above 5%, you were beating inflation, but if you were below 5%, you were not beating inflation. So what you can see is that none of the ABSA funds beat inflation over the 5-year period. But if you look at the 10-year period, and again, over that 10-year period, we actually at about 5.5% on inflation. There we're actually starting to beat inflation by about 2%. So over a 10-year period, a CPI plus 6% fund actually beat inflation by 2%. So really the expectation that you should be doing well by just investing into these kinds of assets, not really being realized. But the point, of course, is also that this is not something that was limited to ABSA. If you look at Allan Gray, they have a very similar result, a little bit better, Allan Gray balanced than the ABSA funds. But if you look at the 3-year return and the 1-year return, not much better. If you go to Coronation in on the 10-year period, a little bit better, but on the 5-year period, a little bit worse. So on 5 years, 3.6%, so roughly 1.5% to 2% below inflation on their balanced funds. Discovery, which is really an Investec fund, also the 3.9% below inflation. Momentum, the only 5-year return we have there, 1.8%. Net Group, around the 4 to 5%, so roughly just getting to inflation. If we just move on to the next group, there you see 91 actually did fairly well. So 91 has actually got two funds that beat inflation over the 5-year period, the 91 managed fund and the 91 opportunity fund. So 91 seemed to be slightly better. Then if you go to prescient, absolute balanced 1% per year for the last 5 years, 6% for the last 10 years. So really nothing to write home about. The prescient wealth balanced fund of funds at about 5%, so at least getting even with inflation. But remember now, what you should be expecting is to beat inflation by a substantial margin over a 5-year period. And then you see the Prudential, same story, PSG, over a 5-year period, virtually not getting any returns on their CPI plus 5 fund. So a lot of people being very disappointed there, I would expect. The Sanlam stuff, also 3.5%, 4%. So what you can say is across the board, with one or two small exceptions, over a 5-year period being roughly in line with inflation on balance funds rather than beating inflation. So what this means is that South African investors who are invested mostly through their pension instruments, meaning their local pension funds or their local retirement annuities or their local life annuities, have now missed out on roughly a third of the value of what their investment should have been, because they've been invested in a low return period. So what I would say to you is that it's very scarce to get a fund manager who is able to work through a low return period and get to a much better result than the market offers you. So this is the worry, is that we may be going into something resembling this on a global basis over the next 5 to 10 years. And the question is, how do we deal with this going forward? So if you, for those of you who've been attending, you will have seen many times where we showed the low returns on interest-bearing investments in the US. Now, again, if you're thinking globally, effectively you think dollar returns. My thought to people who ask me why we only follow dollar returns is that the moment that you switch on the TV and in the evening and they quote you the oil price and the gold price in euros, then we'll start tracking euro returns as well. In the meantime, what you actually want is dollar returns. And the starting point of the potential low return environment is that the first portion of your return, which is the return on interest-bearing investments, just short-term interest-bearing investments, is likely to be very disappointing because the interest rate in the US is currently 0, and there's lots of speculation that interest rates may go below 0 on the short side. Whether it does or not, in my mind, is not all that important. But what is important is that there's every expectation that at least for the next 5 years, that interest rate will stay 0. So the starting point is that you are likely to have somewhere between 1 and 2% inflation and a 0 return. So you're going to fall behind inflation by 1% or 2% annually on your short-term interest-bearing investments. And you may have noticed that in South Africa, that low return on short-term investments have actually caught up with us as well. So short-term interest rates have come down 3% since the COVID crisis hit. So your fairly comfortable 7% money market rate has turned into a much less comfortable 4% money market rate in South Africa. But in the US, effectively, that rate is 0, and it's going to stay 0 for quite a long time. Now, the first kind of risk premium that you can normally earn is the term premium on bonds, meaning The longer you are prepared to leave your money in, the more your return should be. That is called a term premium. So when the US Treasury issues bonds with a fixed term, then you would expect to get a higher return the longer the term becomes. So the best return is typically on the 30-year Treasury bond. Someone is scratching their blackboard. So what you can see there is that if you take it from roughly 2006 onwards, you can see on this graph that what you find is that interest rates go all the way down from about 5% to less than 2%. So in essence, what's happened is that the term premium on bond investment in hard currencies has also shrunk dramatically. So where you would normally have expected to have a return of about 5%, you're now actually talking about a return of about 1.5%. So again, by investing into bonds, so remember now what happens is if you want to describe a balanced fund, typically what we do is we talk about a 60-40 fund, meaning what companies do is they invest 60% into shares and 40% into bonds. And you can see the balanced funds globally tracking that 60-40 index measurement very, very closely. So if you invest 40% of your funds into something yielding 1.5%, then the potential for fantastic performance going forward starts to become limited. That's not to say that you can't have major gains on these investment instruments in the very short run, because what happens is if interest rates go down from 1.5% to 0.75%, the value of the bonds representing it still actually goes up quite a lot. The problem is that over longer periods, those gains tend to be small, and you actually end up with a yield on these bonds when you start. So on that 40% of your portfolio, you're going to earn a very small risk premium, if at all, because in fact, inflation is likely to be lower than the 1.5% that you're earning on your 30-year bonds. So you're locking in a 1.5% return for a 30-year period in an environment where you should expect inflation to sit somewhere between 1% and 2%. So America officially has a 2% inflation target, but we think they may struggle to get to that inflation target from the bottom end, meaning we think that inflation may well be lower than the 2% that they are targeting, but they'll eventually get at least close to the 2%. So the 1.5% not offering you much. The interesting thing is that on TIPS Treasury inflation-linked bonds, you actually have a negative return. So if you're linking your investment to the inflation rate, then from day one, you are locking in a negative return going forward. So the term premium is not going to help you going forward. So if we move along and we just have a look at the global environment. So first of all, let's just have a quick look at the yield curve in the US. So what you find is that over the last year, the yield curve has shifted downwards. So you can see that a year ago, the yield curve was already flat, meaning the yields on long-term bonds were already fairly low relative to short-term interest rates, but at least short-term interest rates were still around the 2% level. You now see short-term interest rates at a 0% level. And actually, if you want a positive yield on your bond, you have to go to a term of more than 5 years. And roughly at the 30-year period, you actually get to a point where you are earning a little bit more than 1% a year, which you lock in for the next 30 years. Now, one of the things that you can do if you are looking at the US is to say, but let's not limit ourselves to the US. Let's have a look around the world at what yields might be. And if we then look at the German yield, you will actually see that German yields have been lower already. So if you look at the German 10-year government bond yield, you will see that for a significant period already, the yield is less than zero. So effectively, you are locking yourself into a 10-year period during which you are going to have a negative return, roughly negative 0.5% if you look at that graph. So you can lock in a 0.5% negative return if you invest into German bonds. So not much to be had there. So if we move on and have a look at Japan, of course, you would expect that in Japan things are even worse, and you would be right. If you look at it, Japanese 10-year government bonds have been hovering around the 0% level for a couple of years now. For roughly 4 years, rates have been negative in the Japanese market. Now, the interesting thing is that, of course, if you are the German or Japanese government, or even the US government, this means that you can now afford to make a huge amount of debt, and the cost of that debt is very low indeed. In fact, the cost of the debt may be negative. So if you are the German or the Japanese or the American government, you should be looking around for projects with a small positive return. And if you can invest into those projects, let's just take green energy as an example. If you were able to get green energy projects on the go and actually get a positive return on those. Now remember, in South Africa, we've had energy projects for quite a while now where we've had negative returns. So it's not to say that just because you're building a power station, you'll have a positive return. But by the way, if you're German and you're reasonably competent, you should be able to do it. And you can get a positive return. So for governments, the implication of this is very different from the implication for investors. But the implication for investors is that even a diversified global bond portfolio not likely to be extremely positive. So what if you were to go to the remaining mainstay of long-term investment, namely equities? If you invest into equities, you would normally expect to get roughly a 6% premium, risk premium. And this is now not a term premium in the way that you would earn on a bond, but it's literally a risk premium. The risk that in business things can go wrong is what leads people to only invest if they expect on average over time to be able to earn a premium of 6%. So for those of you familiar with the efficient markets hypothesis, the comforting thing in the efficient markets hypothesis is that if you just invest into the stock market, you don't have to beat the stock market, because we know that's extremely difficult. But if you just invest into the market and wait, you will earn eventually a risk premium of about 6%. Now, I just took the biggest market in the world, the American stock market, and the normally used measurement for that market is the S&P 500, and I took the PE ratio. Now, the PE ratio is the ratio of prices to earnings. So effectively, this tells you how many years you will expect to wait if you just took the profits of your investment. And you can see there that this graph now comes from the 1920s onwards, so it's a very long-term graph. And you can see that the average there is probably just over 10 PE, and we are currently sitting at a 22 PE. And we can see some historical precedents. So you can see that in the early 1930s, because of the collapse of profits in the 1930s during the Depression, you had a PE of more than 20, and then you had a PE of more than 20 again just after the Second World War. And then during the 1960s, when people were extremely optimistic, flying to the moon and so on, you hovered just below the 20. And then you have two incidents where you exceeded the 20 very significantly. The one was the IT bubble of the late 1990s, early 2000s, where the PE on this S&P 500 went all the way up to 40. And then you had the incident of 2008, 2009, when the PE actually rocketed over 100, but that really has more to do with the collapse in profits than actually the prospects. So what we're seeing now is we actually expect, because remember, this is now a trailing PE, it doesn't take the future of profits into account. We actually expect profits to become significantly lower. Reported profits over the next year will be significantly lower. So actually, if prices don't go down, we expect the PE ratio to just automatically go up quite a bit from here as reported profits collapse. But what it says to you is that by any historical means, shares are already expensive. Now, it may be that we are going into an era where, because of the way technology works, etc., we are going to have fantastic returns on shares, and we'll end up with a 6% more than inflation anyway, even though we start at a high point. But that seems to be fairly unlikely. So the thing that happens is that if you now start looking around the world, things are not quite as dire. There are pockets of places where you will actually find value. And one of the things that you will look at when you look for value is to look at the spread on longer term bonds, meaning the spread between short-term bonds and long-term bonds, because it gives you an idea of what you can expect to earn as a premium on long-term bonds. And what you see here is the spread between 2-year South African bonds and 10-year South African bonds. So you can see that that spread normally is just below 200 basis points or 2%. So what you would do is you would normally expect to earn 2% more on 10-year South African bonds than you would earn on 2-year South African bonds. And what you can see is that in this case, we now actually have a situation where you can earn 400 basis points or 4%, actually a little bit more than the 4%, between 4 and 5% more than on 2-year bonds. So actually, there's a very nice investment opportunity in South African bonds. But obviously, if you're thinking globally, that's a very esoteric, very narrow investment with its own very significant risks. So what any commentator in the room, if we take the room as everyone present on this, would say is, but by the way, have you taken account of the specific risks that are presenting in South Africa? So yes, there's risk, but there's also return. So if we're looking around the world, we're saying there are plenty of places where there's risk without return. So here at least we have return with the risk. If we move along and we have a bit of a look around, so the first thing I want to look at is just the South African yield curve. So what you see on this graph, there's a dotted orange line that was the yield curve in South Africa 6 months ago, meaning before the coronavirus hit. So short-term interest rates were at about 6% and long-term rates peaked at about 10%. What you see now is that short-term rates have come down significantly. They are about 4%, but long-term rates have gone up, so they are about 12%. So effectively what you're seeing is that long-term rates have gone up while short-term rates have gone down. Now, there's a combination of things that work. Part of it is the fact that we have now officially become, had junk status imposed on us by the rating agencies. But the more important thing is that there's a worldwide liquidity squeeze on emerging markets, and that actually reflects in government bonds on the long end. Now, again, one of the things that you would think about, if you think about the other side of this equation, if you are the South African government and you have to now borrow large amounts of money, in order to close the gap on your budget deficit, which is suddenly about 12% of GDP, you should really be borrowing on the short side, because otherwise your debt is going to become extremely expensive. But borrowing too much on the short side can also make you vulnerable to lots of redemptions at the same time. So governments would normally want to have a spread of borrowing actually tending to the long side, but at least temporarily the South African government should be borrowing a lot of money on the short end. If we move along and have a look at some other countries, some other emerging countries, here we see the yield curve for Indonesia. Now, Indonesia is actually a country that is slightly less developed than South Africa and certainly has a less developed financial system, but you can buy Indonesian government bonds, and there you see that short rates in Indonesia slightly lower than in South Africa at about 2.5%, 3% on the short end, but at the long end you are still earning about 8%. So again, in Indonesia you can earn a nice premium. Remember now that you would be taking on board the currency risk. But what you will see is that the currency is also undervalued. So you can actually make a double whammy if you are investing into this. From a dollar perspective, is you can have the appreciation of the Indonesian currency, as well as you can earn a very nice yield, thank you very much, on your longer term bonds. And you may well actually have a profit on those bonds as long rates fall to be more in line with short rates over the next year or two. If we move along to the next graph, we see actually something that's interesting. This is Mauritius. So one of the reasons why I included this is one of the things that I find among my clients is a lot of my clients are thinking that Mauritius may not be a bad alternative to South Africa. And what you see is that Mauritius also has a reasonably steep yield curve, but not anything like the South African or the Indonesian thing. So what you see is that short rates in Mauritius are virtually zero. What is that? What does that reflect? The fact that there's virtually no inflation in Mauritius. And then you have a reasonably flat yield curve, which basically says there's a lot of confidence in the government and its ability to repay debt in the future. So this actually reflects the fact that markets rate the Mauritian government as very responsible. So if you're considering moving to Mauritius and you said, are they financially sound? This actually says, yes, they are actually quite sound from a financial point of view, but it doesn't present itself as a fantastic investment opportunity for South African investors necessarily. Shall we move on? Okay, so we've actually worked through our graphs. So what I want to do is basically pull all of these strands together and say, what we see is if we look around the world and we look at something that is a gimme, where we think that it's very likely that we'll earn something like a significant risk premium, the only thing we can find is emerging market bonds. All the other stuff that we're looking at actually looks expensive, including shares. Now, again, if we are making an investment and well, so the starting point is to say, when you start thinking about investments, we would first of all say, what would happen if we had to invest our money now and not touch it for the next 5 or 10 years? What would the result be? And actually, if we look at the funds that we looked at the start, we find that that's pretty much what investment managers do. They invest into shares and bonds and a couple of other things, and they pretty much just stick with those investments. And whatever happens to those investments is what happens to the funds. There's not really a huge amount of value added from the level of the fund manager. So pretty much that's the normal standard. And what we would have to say is, we think that if we invested now into a balanced global fund that basically had roughly 60% of global equities and 40% of global bonds, most of those shares and bonds in developed countries, we are likely to end up with very modest returns. So we're not saying that these things will collapse. We're just saying over the next 5 to 10 years, the normal investment returns that you would expect in normal circumstances are actually difficult to attain. And it's difficult to imagine that you'll have fantastic returns. So likely to be modest returns in this period. Now, the second point that you would make is, okay, we now have two alternative ways to go. The one is to say we don't want to just invest into the normal suspects. We want to make more alternative investments in order to make sure that we gain a reasonable return. So the interesting thing right now is that if you look around the world, and I'm pretty confident that this will be the case in the US soon, if it's not already the case, but it's certainly the case in South Africa, is that although large listed companies are fairly expensive, you can buy businesses that are under great strain because of the virus lockdowns for very cheap prices. So there's actually a lot of financial strain out there which are creating opportunities to buy things. So I have some contacts in the investable car environment. And what they're telling me is you're getting cars that you would never expect at prices that you would never expect right at the moment, because some people are experiencing strain and they are forced to sell what they have. So, for instance, you might pick up bargains in classic cars, but you might pick up bargains in businesses. So if you wanted to own a travel agency, you might be able to buy yourself a travel agency at bargain basement prices at the moment. If you wanted to own a restaurant, you might be able to buy yourself a very good restaurant with a very long track record of profitability for next to nothing right at the moment. So there's actually a kind of a very large dichotomy between on-the-ground business investing into especially smaller businesses and the very high prices that you see for listed entities. Of course, on the stock exchange, everything is not the same either. One of the things, I started in an era where you were very hesitant to diversify your client's Remgro portfolio because Remgro outperformed everything else on a regular basis. If you look at the Remgro share price, it's still very much lower than the price you were paying before it. So there are instances of low prices, but if you look at the overall indexes, they don't really present themselves. So it may be that a value strategy or an unlisted investment strategy gives you an opportunity to earn a better return. The other thing that you might do is you might actually say that you want to invest into something that gives you a good return but is not correlated to the equity markets. So this is really where you get into the hedge fund universe. So in the hedge fund universe, you get so-called correlated funds, meaning funds that do go up and down with the stock markets. So they're just another way to exploit the stock markets, and they typically use some gearing and so on. So on the hedge fund side, that's not really where you want to go, because if you don't expect equity markets to perform, that's not where you want to go. But there's a lot of hedge fund strategies that don't depend on strong equity markets. So if you think about long-short equity funds, for instance, they basically focus on the difference between various shares. So they would short those shares that they think are overvalued and go long of those shares they think are undervalued. And it doesn't really matter which direction the market goes because you're not net exposed to the market. As long as you're correct about which shares are overvalued and which shares are undervalued, you can make money. So we think that there is a place in our investment strategy going forward for exposure to those non-equity related hedge funds, because they are really, hedge funds in essence are businesses that operate in the financial markets where you don't have to go through the stock market to get your returns. You get your returns directly from the return because of the liquidity of the underlying investments of the fund. The fund can pay you out your profits at any time. So hedge funds, and especially uncorrelated hedge funds, seems to be a source of returns. The other thing that may well yield us a very good return is lending, because in essence what happens is that banks in the current circumstances are likely to stay extremely conservative. So after the 2008 incident, an opportunity arose to lend to people who would normally, before 2008, have borrowed from banks, but are now not considered investment grade, if you like, by the banks and the regulators, and therefore you can lend to them from funds and earn a very good interest rate. So we may well be able to use some of that. And then you get to what is called global macro strategies. So if you're thinking about, for instance, dynamic parity, which is a fund that a lot of our clients are invested in, which is very diversified. But the problem with a diversified fund is that the diversification by itself is not going to solve your problem, because all the portions of your diversified fund start with high valuations at the beginning. So in the long run, even though the diversification will keep the volatility under control, it really won't give you fantastic returns. But the other thing that they do in the fund is they do what they call speed changes. And this is really a typical global macro strategy. So what they do is whenever volatility is very high, they make their exposure very low. This is why they didn't actually get caught in the downdraft in March too much. But it's also the same reason why they didn't actually participate in the updraft just after the downdraft, because volatility was still too high. The interesting thing there is by the beginning of July, the volatility signals told them to be in the market. So the dynamic parity fund actually had a roughly 9% return for July, because virtually all the components of the fund went up. Now, again, if you find that all the components in a fund goes up, it also says that at some future date, all the components may go down. But the basic approach is to say, if we see volatility spiking, higher volatility always precedes large drawdowns. So we are likely to miss large downdrafts, but we will participate when volatility is low. So you can follow strategies like that as well, which is actually typical global macro hedge fund strategy. Then the other thing that's interesting to me is that part of what we've seen in the last couple of months is that we've seen basically for the last 5 years, you've seen a split between so-called risky assets or risk-on assets and risk-off assets. So risk-on being things like equities and emerging markets, risk-off being things like gold and bonds. And you would typically see on a specific day that those two things would always move in opposite directions. So it's either a risk-on day or a risk-off day. What we've seen recently is that because of the massive creation, well, first of all, the massive contraction and then the massive creation of liquidity, we've seen all non-cash assets go up or down on the same day. And what this really means is that central banks and their creation of money is what is driving markets at this point, and not really a perception of risk of what's out there. And this really means that the authorities are dictating prices, and they're dictating prices that are higher than the markets would normally have, and therefore, effectively, the yields going forward is likely to be low. Which really brings me to the last strategy that we might follow. And the last strategy we might follow is the one that says, you know what, things are very expensive now, but it doesn't mean that they will always be expensive. There will be events that create big downdrafts in markets at some point in the future, especially if you start with markets that are too high. And one of the things that's driving markets at the moment is the fact that you are seeing a massive creation of liquidity with very little need for liquidity in the markets, meaning businesses are not taking up loans and investing the money into new projects, just because everybody has put all their new projects on hold until we see the end of the coronavirus issues, and not only the end of the coronavirus issues, but also essentially the end of the post-corona recession, if you like. And I'll get back to that in a second. But effectively, one of the things you can do is to say, as the economy gets going again after the coronavirus, there will be an uptake of money in the real economy, which will suck money out of the financial markets. And that central banks will be happy to let that happen, because there will be some growth in the real economy, which is what they wanted to achieve. So they will not necessarily fight that outflow of liquidity. And that could very well bring about a significant downdraft in markets in the fairly near future. So one of the strategies you could follow is to actually park your money either in something that you think will give you a reasonable return, like, for instance, emerging market bonds, or just in cash, if you're wary of the exchange rate situation, and wait until a downdraft comes and then reinvest the money. So one of my wise colleagues in the past used to say that in financial planning, or wealth management then, if you like, it's very often a good thing that when you are in doubt, do half. So effectively, if we are struggling to think about how we might make sure that our clients get the normal expected return over the next 5 to 10 years, we might do a little bit of each of the strategies that we might follow. So we might go out and say, let us buy a little bit of emerging market bonds and get the good yield on those bonds. We know there's some risk to it, but we don't overcommit ourselves to that specific strategy. Let us then go out and make some investment into into lending, if you like, credit, where there's likely to be, if you're careful, there's likely to be some opportunities in credit. So let's take some exposure to global credit. Thirdly, let's actually make some investment into non-correlated hedge funds. Fourthly, let's make some investment into funds that are likely to time the markets, meaning something like dynamic parity, which will move in and out of the market according to the volatility levels. And then lastly, let's also keep a little bit of cash so that if an opportunity presents itself, we are able to make use of it at some point in the future. So in business, it's virtually always a bad idea to do something by half measure. In wealth management and financial planning, it's very often a good idea to take half measures, to take a little bit of one thing and a little bit of the other and a little bit of the other, And I guess you could think of it as a diversification of strategies rather than a diversification of assets. So from our point of view, we continue to think very carefully about how we might make sure that our clients can get a higher return or as high a return in the future as they did in the past. Unfortunately for South Africans, they're already 30% behind on their local assets. So again, we continue to think that it's much safer from a wealth preservation point of view to do global investing. But then at the same time, we also think that it is prudent for clients to start accepting that for a while at least, returns might be lower, and that you should start planning for a lower return environment, meaning you shouldn't get yourself into a position where if the very high returns that eventuated between, let's just say, 1980 and 2008, if those returns don't actually eventuate in future, you shouldn't find yourself in trouble. So in terms of planning, we also think that it's prudent to start using slightly lower rates of return in future as our planning default. I think enough said. Questions, comments?
Wikus, thanks very much. I've had a couple of questions from people who are talking about gold, particularly because it now hit the $2,000 mark. And secondly, again, the following distance that we recommend as well. Could you comment on both of those?
Yeah, so I would say, first of all, one of the things that I actually neglected to mention is one of the alternatives, obviously, is that you can invest into a variety of commodities. And of those commodities, the thing that presents itself most is gold. So the kind of circumstances we're talking about with very low yields and high amounts of money being printed by the authorities are typically the circumstances that would be positive for gold. So already the fact that gold has moved up, you will recall that we've been saying gold is one of the things that should benefit. The problem with gold is that as a single investment rather than part of a more diversified portfolio, as a single investment, gold typically, gold has no underlying use case. Meaning gold is valuable because people think it's valuable. And therefore, we never know when gold actually, there's no underlying reason why gold has to be valuable. And therefore, we think that it's always good to have a portion of your money in gold, but not too much. So what we would say is these are the circumstances that gold should do well in. And we think that the gold price will go up. So gold is one of the things that we think you should be invested in. And you're actually getting a slug of gold if you're investing into dynamic parity. It's a part of that diversified portfolio. But putting a large bet on gold only is always a very risky strategy because you just don't know what the underlying value should be. Because normally you would calculate the underlying value of any investment according to its yield. And given that there's no yield on gold, how do you then calculate that? There are, of course, while we're talking about gold, there's a new generation of people who think that Bitcoin is the new gold. The problem that we see with Bitcoin, and it may be that Bitcoin becomes a bit more conventional over the next couple of years, but the problem with Bitcoin is that cryptocurrencies as a class of assets are actually fairly easy to produce. And therefore, if there's too much supply, that can always put the future price under pressure. So we are very cautious about going into the cryptocurrency space. So we're not really recommending that to our clients. But again, the the low yields on normal hard currencies is the kind of environment in which you would actually expect cryptocurrencies to also do well. But to some extent, gold is a little bit like Bitcoin because it has no underlying use, and therefore, what should the eventual value be? Difficult to tell. Then the next question is the following distance thing. And part of what we would say is that the less confident you are about reasonable returns on your long-term assets, the longer you should typically make your following distance. But it also depends on what the yield on the assets in your following distance should be. So typically what we would say is we try to actually make our long-term investment in such a way that we at least think that a portion of those assets will perform within 6 years. So the period that we look for in following distance, we really use a 3-tier thing. So the first is we think that we basically use money market or cash for the short term, which is up to 3 years. And there we are, even with a kind of third year of a 3-year investment, especially if it's rand investment, we'd start actually thinking about taking some bond exposure. Then the 3 to 6 year period, which is really what we call medium term. At this point, if you're a South African and you need to spend rands, there's a fantastic alternative. You can go into South African bonds, you'll get a great yield. You're likely to get some capital gains, so we're actually quite confident about our returns there. But it's really the long-term stuff that we worry about. And on that long-term stuff, we think there's a couple of things to watch out for. The first thing is that if you take your money out of the country right now and you don't hedge the currency back, then you're likely to not get a great rand return, because actually you're turning your rands into dollars at a point where the rand is too cheap. And secondly, that global assets don't offer the traditional opportunity. So the traditional conventional solutions, the typical 60-40 funds, we think that people are not going to get a great deal of joy out of that. So I think that you should be looking for alternative ways to arrange your affairs from the traditional conventional 60-40 funds.
Thanks, Wikus. Are there any other questions? All quiet out there.
Yeah, maybe just a last little comment. If we're looking around the world at the moment on the coronavirus, it's starting to look like the coronavirus might have peaked in Gauteng and the Western Cape in South Africa. So because of the way that testing is done, we can't really be sure. But it's looking like the peak in the coronavirus is slightly earlier than one might have thought. So a little bit of good news, I think, in that.
Thanks, Wikus.